Down 1.7% here, a loss of 37 points or so.
We're down over 16%.
Dow at the same time has fallen about 18%.
The stock market is now down 21%.
Hey everyone, let's have a real talk for a second. Have you looked at your portfolio lately? Or maybe you just looked at the price of a carton of eggs and felt a small piece of your soul leave your body? If you feel like the ground beneath the global economy is a little bit shaky right now, you are definitely not alone. Everywhere you look, the headlines are screaming about market volatility. It feels like every time we refresh our feeds, there is another red day on Wall Street. But here is the thing. We have seen this movie before, or at least we think we have. There is a giant trillion-dollar ghost haunting the market right now. It is the ghost of 2008. Remember the Great Recession? The housing bubble? The too big to fail banks that actually kind of did fail? Well, it is mid-2026 and the data is starting to look a little bit too familiar for comfort. People are asking the big question. Are we repeating the 2008 housing bubble today? Is the next trillion-dollar crash already baked into the cake? Today we are going to look at the cold, hard numbers. We are going to compare where we are right now in 2026 to those historical indicators that preceded the last big collapse. And most importantly, I am going to give you 3 defensive moves you can make with your portfolio today to make sure you aren't the one left holding the bag. Stick around because understanding this could be the difference between losing your shirt and actually coming out ahead when the dust settles. Let's start with the vibe of the market. In 2008, the crash didn't just happen overnight. It was a slow burn of overconfidence. People were flipping houses like they were pancakes. Lending standards were basically, do you have a pulse? Fast forward to right now. While we don't have the exact same subprime mortgage crisis, we have something else. We have asset prices that have detached from reality. Look at the data from the first half of 2026. Real estate prices in major hubs have hit levels that make 2007 look like a clearance sale. But it isn't just houses. It is everything. Stocks, tech, even digital assets. When you see a line go straight up for too long, gravity eventually remembers it exists. History tells us that bubbles are built on the idea that this time is different. Is it different this time? Well, in 2008, the trigger was debt. Specifically, bad housing debt. In 2026, the trigger might be different, but the symptoms are the same. High interest rates are finally starting to bite. Consumer debt is at an all-time high. The easy money era is officially dead and buried. If it looks like a bubble and smells like a bubble, we should probably check if we are standing in the splash zone. Let's get into the nitty-gritty of why the crash narrative is everywhere right now. It isn't just for the clicks, although let's be honest, those market doom thumbnails are very effective. There are 3 major red flags we are seeing in the mid-2026 asset data. First, the yield curve. If you want to sound smart at a dinner party, mention the inverted yield curve. Historically, when short-term debt pays more than long-term debt, it's the market's way of screaming recession incoming. It has been a nearly perfect predictor of crashes for decades. And guess what? It has been screaming for a while now. Second, the affordability gap. In 2008, people stopped being able to pay their mortgages. In 2026, many people can't even get a mortgage in the first place. When the average person is priced out of the American dream, the demand side of the economy starts to crumble. Third, corporate debt. This is the one people aren't talking about enough. A lot of companies survived the last few years by taking on cheap loans. Now that rates are high, those loans are getting more expensive to pay back. We are seeing zombie companies finally running out of brains. This creates a domino effect. If companies can't pay their debt, they lay people off. If people are laid off, they can't buy houses or spend money. If spending stops, the market crashes. It's the circle of life, but much less musical than The Lion King. Okay, I don't want to just leave you in a puddle of anxiety. Panic is not a strategy. If a crash is coming or if we are already in the middle of a correction, you need a plan. Here are 3 defensive moves to consider for your portfolio right now. Move number 1. Cash is no longer trash. For years, people told you to stay fully invested because cash loses value to inflation. That was true when interest rates were 0, but in mid-2026, having dry powder is a superpower. If the market drops 20%, you want to have cash ready to buy the dip, not be forced to sell your winners just to pay the bills. Move number 2. Focus on needs, not wants. In a crash, people stop buying designer sneakers and high-end tech gadgets. They do not stop buying toothpaste, electricity, or healthcare. Look at defensive sectors. Companies that provide essential services tend to weather the storm much better than the disruptive AI startup that doesn't actually have a profit margin yet. Move number 3, deleverage your life. If you have high-interest debt, pay it off. If you are trading on margin, stop. In a trillion-dollar crash, debt is a weight that pulls you under. Being lean is the best way to survive volatility. Think of your portfolio like a ship. A crash is a storm. You don't want to be patching holes in the hull while the waves are 30 feet high. You want to have the holes patched and the sails tucked away before the rain starts. So, are we repeating 2008? The honest answer is that history doesn't repeat perfectly, but it definitely rhymes. The ingredients for a major correction are all on the counter. High prices, high debt, and high uncertainty. But here's the good news. Crashes are where the most wealth is actually made. If you are prepared, a crash isn't a disaster, it is a fire sale. The goal isn't to predict the exact day the market hits bottom. The goal is to be in a position where you don't care because you are protected. We are living through a wild moment in economic history. Don't let the crash narratives paralyze you. Use them as a wake-up call to audit your finances and get your strategy straight. Ultimately, the biggest danger isn't just a falling chart. It is the psychological trap of thinking things will stay great forever. When optimism replaces math, reality usually makes a messy comeback. By staying alert and keeping your emotions out of your brokerage account, you turn a potential catastrophe into a massive opportunity. I want to hear from you. Do you think we are in a bubble right now, or is this just a healthy market reset? Drop a comment below and let's get a discussion going. And if you found this breakdown helpful, do me a huge favor. Hit that subscribe button and turn on notifications. Stay smart, stay hedged, and I will see you in the next one.